This is the Geopolitics and Empire podcast, and we're speaking with Michael Pento, who is the author of The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. He is also the chairman of Pento Portfolio Strategies at pentoport.com. We'll be talking about the coming global financial crisis, the debt bubble, and its endgame. Thanks for coming on Geopolitics and Empire, Mr. Pento.
Thank you for having me on, Hervoyer.
Now, I must admit that of all themes we cover here on Geopolitics and Empire, the economy isn't my strongest suit, which is why we have guests such as yourself on to break it down for us. But the fact that the global economy is set to pop should be obvious for all except the willfully blind.
Wow.
When I have guests on to talk about the economy, we're long past debating the situation. It's kind of understood that we're heading for economic doomsday. And I feel each guest has a unique experience to contribute with insights that differ from each other. But before we get into it, I'd like to get your thoughts on the cause of all of our troubles, which you detail in the book. One thing that I've noticed in the West is this growing trend of Marxism, and many people today are blaming capitalism for our economic problems. But in your book, you don't blame capitalism. You lay the blame on central banks and fiat money, among others. So could you briefly tell us your thoughts on who is to blame for this crisis?
Well, first of all, Hervoyer, I mean, you say you don't know much about the economy, but I think you know more than anybody on Wall Street. I mean, I can't believe that you have come on the show and said that you blatantly believe that the global economy is headed for a recession/depression or some kind of crisis. That's something that most people can't understand. So congratulations on that point. Basically, and this is going to be hard to summarize my book and my theories in just a 30-minute interview. But basically, the central banks, and not just the United States, central banks around the world have inserted themselves into markets, into free markets, to a degree that has been now realized to be unprecedented. And let me just explain what I mean by that. So in 1913, when the Federal Reserve was formed and codified by Congress, they were given certain powers to help distressed banks that were in need of capital. So they would lend to these banks at the discount window at a penalty rate. That was it. They were not involved in the economy. They weren't involved in the financial system to a great degree. They weren't involved in the integral vacillations in the money market. And they certainly were not at all supposed to be concerned about the stock market. And you fast forward to 2019 to where we are today, and it was progressive. We broke the gold window in 1971, and then in 1987 we had a stock market crash, which Greenspan, the then Fed chair, came in and printed a bunch of money and enacted something called the Greenspan put in '87. Then you had the Russian debt crisis and the Asian debt crisis, and the failure of some big hedge funds, long-term capital management foremost among them in the late 90s, which caused more central bank intervention. Then you had the collapse of the NASDAQ in the year 2000, caused more central bank intervention, until you had 2008, the Great Recession of 2008, where central banks basically took interest rates to 0% and left them there for almost a decade. Not just the United States, but the Bank of Japan, the People's Bank of China, the ECB, European Central Bank. All these banks lowered interest rates dramatically. Bank of England, National Bank. All of these banks lowered interest rates incredibly. And in some cases, in the case of the ECB and the Swissy and Japan, rates became actually negative. To the point now where there's $11 trillion worth of sovereign debt around the world that has a negative sign in front of it. So we find ourselves at the point today, Hervoyer, where global central banks have become the economy, and they've done this by, as I've said, artificially manipulating interest rates to an unbelievable and unprecedented low around the world, which did two things. It engendered a huge increase in the levels of debt, both in the public and private sectors around the world, and at the same time created massive asset bubbles in fixed income, real estate, and in equities. That is why I will tell you that the world's situation today is the most tenuous that it's ever been. And it's completely predicated upon, based upon, and held together through these massively distorted and artificial low interest rates. And when that ends, that is when the reality check will come to markets. And you might say to me, well, Michael, what will cause interest rates to mean revert? And I will tell you two things. One thing will be a recession, a very sharp and deep, trenchant, cutting recession, which will send debt levels in the sovereign arena through the roof, and that will engender a rise in interest rates and or an outbreak of inflation. So until you have one of either one of those conditions, and they're not mutually exclusive, Hervoyer, they can happen together. You could have an outbreak of stagflation, which is probably actually most probable. But until you get a recession and or inflation, this illusion can continue, but it is on borrowed time.
As you mentioned, there's this huge debt bubble, as well as other bubbles. Some people call it the everything bubble. I believe Jesse Colombo of the Real Investment website. And you publish a newsletter, which I just discovered, thankfully, and I subscribed. And in your most recent letter, you detail a number of points of failure in the economy. And just today, President Trump has attacked the Fed, and Trump has said the U.S. is experiencing low inflation. And meanwhile, stocks seem to be slightly rallying again. But I mean, in the near term, what are some of the key canaries in the coal mine that you're looking at right now? I know in your newsletter, you also mentioned bank failures like Deutsche Bank. I'm here in Kazakhstan, and in the last 2 years, we've seen multiple banks fail. Turkey's financial crisis has threatened Spain's Bancomer, and as well, Deutsche Bank. And if that fails, that can start a chain reaction. So
I mentioned Deutsche Bank in my latest commentary as well. And that stock was in the 150. Now it's barely above $6 a share, with a massive derivative book. And it's one of the largest banks in Europe, and indeed one of the largest banks in the world. Of course, you had the Baoqiang Bank, which collapsed and taken over by the Chinese government about a week ago too. That could be the canary in the in the coal mine. We had Indie Bank collapse in July of 2008, and at that time, the FDIC chair here of the U.S. Deposit Insurance Chair Sheila Bair said, "Hey, there's nothing to see here. There's nothing to worry about. It's an isolated incident, just like subprime mortgages were an isolated incident." But on that note, we have at the height of the subprime mortgage crisis in 2008, before the economy fell off a cliff, we had $1.5 trillion worth of subprime mortgage debt. And today, you asked one of those where are all the bubbles? Well, today we have $5.4 trillion worth of junk bonds, leveraged loans, and triple B paper. Triple B debt, corporate debt rated just one notch above junk. And they have no covenants, these leveraged loans. So corporate debt's up 40% since the Great Recession. It's a huge amount a record amount of debt. It's a record amount of corporate debt as a percentage of GDP. And this corporate debt is extremely sensitive to the business cycle. So if and when the economy does enter into a recession, this debt is going to be defaulted upon. A massive amount of this debt will be defaulted upon, just like subprime mortgages, and I think it's going to bring down the entire fixed income market with it. That's one of the things I'm worried about here in the United States. Of course, we still have an echo boom in the housing market, where home prices are just shy of where they were in 2008 as far as home price to income ratios. I believe the peak in 2008 was 4.3 to 1. Now they're 3.7 to 1 home price to income ratio. So very, very highly elevated. The normal ratio is about 2.5. So home prices are at a record high. Nominal terms ratio of a ratio of home prices to income very elevated. You've got the fixed income bubble. You've got the stock bubble, which is the largest in history. If you look at home prices, if you look at bond prices and stock prices, the household net worth as a percentage of GDP is an all-time high, 537% of underlying national income. And then, of course, if you look at just stock prices as their market value in relation to the underlying economy, that is now at 140%, which is virtually a record high as well. Only eclipsed in 2000, March of 2000. The high of that ratio was 150%, 148 to be exact. 148% total market cap to GDP. The average of that ratio was about 65. So you have all of these massive distortions, not only in the United States. China is a huge pile of debt. That nation's total debt has quadrupled since 2007. Their household debt is up 700% since 2008. You have to go over to Japan to see that their Bank of Japan's balance sheet is bigger than the entire nation's GDP. The Bank of Japan owns 80% of all of the ETFs and over half of the entire Japanese government bond market. The ECB has negative rates as well. And you mentioned that many of those banks are in trouble. Italian banks are basically insolvent. So it's not just the United States that has issues. It's Europe, it's Japan, it's South America, it's China. So the world is hanging on. It's precariously hanging on by its fingernails to the notion that asset bubbles can be permanently fomented by central banks. And as I said before, if we ever have a recession, or if we ever get the inflation that central banks around the world are so desirous of, then the whole charade unravels, and it unravels very quickly.
Now, before I ask you what happens after the unraveling, what are your just thoughts quickly on the U.S.-Mexico trade war? Is there a bit of a reality show element to it? What are your thoughts there?
Well, the Mexican trade war is over. I mean, they said that there's going to be no tariffs on Mexico. We have to see if the USMCA is ratified by Congress, but that doesn't mean the tariffs are over. The tariffs are over with Mexico because it was never really about tariffs. It was about immigration. We still have tariffs on Chinese goods, and we have tariffs possibly coming on, I think very likely coming on European auto manufacturers. So the tariffs are a problem, but that to me, Hervoyer, is a red herring. The problems that exist in the U.S. economy at this juncture stem from the fact that Trump's tax cuts, and in particular the repatriation and the accelerated depreciation aspect of the tax cuts, they're wearing off. And you're lapping some very, very difficult comps year over year. So that stimulus is wearing off. And then you add to that the fact that I mentioned that China is desperately trying to prop up their debt dung pile, which is teetering and about to collapse as we speak. And they were responsible for 1/3 of global growth. China was since 2000. So if China, China has a falling labor force growth, and their productivity growth rates are falling. So China's GDP is very much in duress right now. And if they were responsible for 1/3 of global growth, and they were, and you take them offline, and then you have the cessation of the stimulus from Trump's tax cuts, and then you add to that the 9 rating. Now, don't forget, rate hikes act with a lag. The Federal Reserve has already enacted 9 rate hikes since 2015 and burned about $600 billion of base money supply through its quantitative tightening program. If you combine those 3 things, you get the real reason why I believe the U.S. economy, and indeed the global economy, is slowing. Now, tariffs exacerbate that move, but they are not the primary cause of it.
Now, I'm gonna have to ask you this question because so many listeners always say, "Why don't you ask the guest about cryptos?" And Kim.
Oh boy, you're gonna go there? Okay.
Just your thought. Just your thought. Kim.com of Mega Upload. He frequently tweets about this economic collapse coming, and that we should all get into gold and cryptocurrencies, which will spike as people seek alternative safe haven assets. Just what are your thoughts on cryptos?
Okay. So, briefly, let me give you my thoughts on crypto. First of all, I used to think they were all going to go to zero. I don't think that anymore. I think that Bitcoin perhaps can be someday worth a fair value of maybe somewhere around $100 per unit or below. So I'm very bearish on cryptocurrencies. And the reason is that they are not money. And just briefly, what money has to be is money has to be something that's rare, indestructible, and very beautiful. Those three things help. Okay, being very beautiful is not, of course, paramount, but something that is considered money has to be very rare and indestructible. Of course, being beautiful, you can wear it as jewelry and you can trade it and exchange it. Makes it an okay currency. Although that's where Bitcoin was supposed to be a better gold because it's a better currency. Although now you can move gold electronically just as fast as you can move cryptocurrencies. But when you think about cryptocurrencies, what are they basically? They're basically digital alchemy. I call it digital alchemy. And the reason is it's just a string of electronic numbers and letters that you hold on your hard drive in the form of a private key. It doesn't have to be on your hard drive. It could be cold stored as well. But a private key, 64 a string of 64 numbers and letters is not money because electronic numbers are not rare and they're certainly not indestructible. So you say to yourself, the only time that they have value is in the context of this network, which allows you to move these keys, these coins, across a anonymous and decentralized and immutable network. That part I get. But when you have thousands of cryptocurrencies all vying, competing, doing the same thing, they're not rare. Electronic numbers are not indestructible. And then finally, I'll say, I'm not sure if Bitcoin itself or the cryptocurrency community knows what they want to be. At one time, the notion was I can move this coin that across the world without a third party's involvement. So it's peer-to-peer network. It's decentralized. That I get. But then the governments say, wait, we're going to regulate you. And Bitcoin says, oh, great, we want to be regulated. So, if you regulate Bitcoin, then you're moving money like you're moving, PayPal or Venmo. What's the difference? If it's regulated, it's no longer anonymous, and it's no longer decentralized, and it's no longer immutable. So it loses its value, in my opinion. The value for cryptocurrencies will be a very small select number of them. Maybe Bitcoin will be the big winner. And you can move your coins out of a country, without the permission of a government. And that's worth something, but it's not worth 20,000 per unit.
All right, so I won't get a bunch of comments now asking me why didn't I ask about.
You're gonna get a lot of comments, believe me, and most of them will hate me.
Yeah. So how long can this go on? Some of when I talk about this with people, some people have told me, this economic crisis in general that's been brewing for years. People will say that. My crazy uncle has been talking about economic collapse since Vietnam in the 1960s. Others will say that, for the past 10, 20 years, things have been overall fine. Life has been good. Yeah, they don't worry. They've some that have been hit by the 2008 crisis, they picked up the pieces and got on with life. And so, what would you say to the average person who doesn't follow closely economics and politics, who laugh at, people like us who kind of sound like Chicken Little for a decade?
Well, Well, they should laugh at us because I mean, if people are permanent Cassandras and say, "Oh, things are terrible. Get out of the market." People who always say that are, for the most part, wrong because the stock market, for the most part, goes up. So, I mean, it's not wrong, Hervoyer. It's not wrong to point out the artificial nature and the artificial construct of what central banks have created. It's not wrong to say one day they're going to fail and fail miserably. All those things are true. But it's another thing to say, okay, well, you should do then is just short the market and buy gold or buy, foreign stocks because the dollar's going to collapse. That's what's wrong. Someday that's going to be true. That's the wrong tactic. I've created a 20-point model, how I manage money, 10 components for the economic cycle, and 10 components for inflationary components. And if you know where to invest your money, depending upon the economic cycle and the dynamics of inflation, deflation, you'll know where to best put your money. And you'll also, hopefully, that's the plan, hopefully, avoid these major drawdowns in the stock market like you had in 2000. The NASDAQ lost 80% of its value in the year 2000 and was underwater for a very long time. And in 2008, the stock market, 2007 to March 2009, the stock market lost over 50% of its value, the S&P 500. So, I mean, if you're in your 50s, 60s, or, about to retire, you can't afford another drawdown of half of your money. Who knows when it's going to come back? I often laugh at people who tell me, stocks always go up. That's just ignorant, to be polite. China's market, the Shanghai Composite, peaked in 2007. It's still down 45% from 2007. That's 12 years ago. And it's down 45% in nominal terms. So in Japan, their epic bubble, their hyper credit bubble, burst in 1989. And that market is down 50% in nominal terms. And that's 30 years ago. So, the idea you could just buy and hold a bunch of stocks and bonds and foreign, small caps, large caps, foreign stocks, and buy and hold. Someday, you'll be fine because stocks always go up. That's just wrong. That's not true. What stocks do you want to buy? Do you always want to be long stocks? Do you always want to be long bonds? You have to have a little more, since everything today is artificial by its nature, you have to have a little more intelligent and a little more active strategy than just buy and hold and dollar cost average, because that will get you burned, just like it did for the people in Japan, just like it did for the people in China. It's coming here to the United States, in my belief.
In your book, you talk about the Roman Empire briefly and discussing its decline. And so, what are your thoughts on the decline of the American Empire, de-dollarization? People talk about de-dollarization, but that seems to be going really slow. And, what do you think if it's going to reach a tipping point? Because I think still 60% of central bank reserves are in U.S. dollars. And, this historical process of decline, it always happens. And we see the American Empire is on the decline.
A lot of people, I think, get this wrong. So yes, the U.S. empire is in decline, no doubt about it. But when you talk about a currency crisis, people always talk about the dollar. Well, the dollar is a paired comparison. So you can't just say the dollar is going to go down without telling me what's going to go down against. And then you're going to tell me that the dollar is going to crash against the euro? The dollar is going to crash against the yen? The dollar is going to crash against the yuan or the renminbi? And this is ridiculous to me. I don't understand it. The United States is the only central bank that managed to end QE. The ECB ended it not too long ago, but the ECB barely ended QE and is still stuck at a negative deposit rate. So is the dollar going to crash against the euro? I don't know. Is the dollar going to crash against the yen when you have Mr. Kuroda saying that he's going to, never get out of QE ever in our lifetimes? And they're stuck. They have a negative deposit rate as well. I mean, is it going to crash against the renminbi? I don't know. I mean, I'll tell you one thing. that it is going to crash against. That's why I mentioned Rome. So, I mean, when you think of a currency pair, well, there was no real pair with the denarii. So the Roman currency, Rome was the preeminent empire for hundreds of years. And there wasn't an active currency exchange market. So yet Romans experienced inflation, virtually hyperinflation, to the tune of 1,000% per annum at the height of the inflation. So yes, the US dollar will collapse. It might collapse against the Russian ruble because Russia has a tremendous hoard of gold. I mean, maybe it'll go down a little bit against the renminbi because China has a tremendous hoard of gold. But what the US dollar is mostly going to collapse against is gold. So you can have gold rising in all currencies, even though the dollar doesn't lose its value against the euro. That's my main point. It all depends on central banks. It depends on growth rates of economies. But why the notion is that we're going to have a collapse of the global economy and the dollar is going to be destroyed. I don't quite agree with that. Don't forget what happened last time when the global economy collapsed. The US dollar actually surged in value. And admittedly, that was because it was an unwind of a dollar carry trade where people were borrowing in dollars and investing in BRIC countries because the yield was higher and the growth rate was higher. That's not the case today. If we do have another global collapse, perhaps the dollar won't rise to the same degree as it did in 2008. But nevertheless, the salient collapse in the dollar will be most manifest against hard assets and precious metals. That's my point.
And are there any other final thoughts or important points that you'd like to mention that I missed?
Well, I don't think you missed much. I mean, in this short interview, we had 9 years of 0% interest rates here in the United States. We didn't. I hear from all of the pundits on the major financial networks, hey, well, 9 years of ZIRP didn't create any economic imbalances. I mean, if you believe that, then go out and buy. Go margin up your portfolio and buy Facebook, Apple, Netflix, and Google. The fact is that 9 years of 0% interest rates created massive distortions. This is the first time in the history of the global economy, the history of global economics, where we've had virtually 0% interest rates worldwide for almost a decade. It's never before happened, and it's created massive distortions in asset prices vis-a-vis the underlying economic growth. And that is going to rectify itself in a very violent and sharp manner. And I manage money for a living, and I dedicated my working life to helping individuals preserve their principal while we wait for this cataclysm to approach, and then actually protect and profit from its demise. And that's the best that's the best that I can do.
And just one more question. I mean, do you think, this is repeated in history over and over again, but more times than not, war has been won besides the economic collapse or crisis. You think? What are your thoughts on potential war?
When you have currency wars and then you have trade wars, sometimes these conflagrations end up in shooting wars. So when a country believes its sovereign interest is being violated, wars occur. So wars are very difficult to predict, but they one thing human history is replete and there is no doubt about this. Every weapon ever made by man has been used and used frequently. And that includes, by the way, I don't exclude nuclear bombs. So that's a fact. I mean, you go through from when the caveman picked up a bone to the arrow to all the munitions ever invented, these weapons have been used frequently and often, with very, very small lapses in history of peace. And unfortunately, I mean, if you go through history and you know history, understand history, human beings use their weapons that they've created, and they do it all the time. So I guess that's a horrible note to leave on. I pray God that it never happens. But the invention of nuclear weapons would be the only time in the man's history that they were only used twice in combat.
Yeah, just a few weeks ago, I live not far currently from the principal Soviet nuclear test site where they dropped 500 bombs, and I actually went to visit the test site. I was on the test site where they actually dropped some of the bombs, and yeah, I mean, very fascinating stuff. How can people best follow you online? I know you're on Twitter and you have a website, pentoport.com.
Yes, so it's pentoport.com is the website. My email is mpento@pentoport.com. You can call the office here, 732-772-9500. Call us up. We want to talk about your investments. We have a minimum investment here of around $100,000 to invest in our inflation, deflation, and economic cycle portfolio. We also have a podcast. It's $49.99 per year. You get all these, great esoteric, arcane data points that you won't see published in most other places. They're certainly not promulgated in many other venues, because I give you the truth. My only incentive is to make my clients money. That's it. And I guess the only other thing I can leave you with is that one thing good about nuclear weapons is that they're used again in history to any great extent. That'll do it for quite a long time. They could only be used, maybe one more time in any kind of great extent. So I don't know if that's good news. I don't know if that's good news.
And I'd recommend people not forget to go check out your book. I just finished reading it, and I would definitely recommend it. Even if if listeners have read many other books on the economy by many of my past guests and other analysts, but I would definitely recommend checking this book out. And thanks again for your time, Mr. Pento.
Hervoyer, it's my pleasure. Thank you.
I hope you enjoyed this Geopolitics and Empire podcast and interview. I would like to remind you that our website is geopoliticsandempire.com, and you can sign up for our mailing list that goes out each weekend with the latest podcast and a long collection of important news headlines. It's good to sign up for the newsletter in case we experience censorship and deplatforming. You can help the Geopolitics and Empire podcast by subscribing to and interacting with all of our channels such as YouTube, Twitter, Facebook, Gab, Minds, and Steemit. You can also help us by leaving a rating and review on your favorite podcast platforms such as iTunes, CastBox, Stitcher, Spreaker, and so on. Finally, if you value our work and our mission and would like to see us continue interviewing experts from across the political spectrum, please consider leaving a one-time donation via PayPal or Bitcoin, or becoming a regular monthly supporter on our Patreon. All the links can be found on geopoliticsandempire.com. Thanks for listening.